Hi, everybody. This is Dan Sheridan. Good morning from Sheridan Risk Management. And I wanted to talk about mixed month spreads calendars today in two situations you're not used to doing them and talk about them. And again, mixed month spreads sometimes can be a pickle for people who aren't used to them. A lot of people may look at a same month spread, like a credit spread or a iron condor or a butterfly. Say, you know what, Dan, that makes more sense to me because all the strikes are in the same month. But again, it's a little bit different, mixed month spreads, but it's okay, right? Once you get used to the creature a little bit. So I'm going to talk about calendars today in two situations and how you might use them. Situation number one would be, what if there's a Fed meeting? Once a month, you have the FOMC Fed meeting. And what would be an idea in small size that might be a possibility during that situation? So, and here's an example. So I'm talking to you on a Monday, right? Monday, May 5th. In 2 days, on Wednesday, Fed Chairman Powell is going to come out at 2 o'clock Eastern, and he will be giving his interest rate conclusion, what he's going to do. Probably nothing, but we'll see, whatever he's going to do. Then at 2:30, he has a press conference where he might give a little more information, a little more insight into what his future goals are. So how do you play that? I mean, as a range bound trader, which I basically am positive theta guy, when I look at the Fed coming up, I say, okay, that's a catalyst that could move something. So do I want to wait for range bound trades till after the catalyst? So maybe Wednesday, late in the day, I might have a better idea how the market's responding to anything from the Fed. Or is it going to be a nothing burger? Or can I come in, maybe you play a little bit smaller size as you come near an event, which I do quite a bit. Maybe get a little more duration, 2 to 3 weeks, so you can handle a move up or down X amount, right? Your deltas can handle that. But what I'm looking at today is it's Monday, and here would just be an example so you can see a visual. I'm going in and I'm selling May 7, buying May 8 in calendars. I'm doing a double calendar, two calendars. And I'm setting, right now we're at 56.71, right around 56.70. And I'm going to place my bullish call calendar at 57.20. And I'm going to place my bearish put calendar at 56.20. Now, I'm purposely having a bit of a sag here, right? I'm purposely doing that, right? If I wanted to, I could bring this up more by bringing my short strikes inward a little bit. But I don't want to do that. Why? We have a catalyst on the table called the Fed announcement. So I want a little more room. And that's where we're at. And then I look at it and say, okay, today's Monday. Maybe I don't want to go through the potential hurricane. It possibly could move it. I don't think it will a lot. But do I got a shot? Do I have a decent shot at getting out this Wednesday before the Fed announcement at lunchtime? And the way I structured this trade is I looked at, okay, I want to get out by Wednesday. The expected move, even with the Fed announcement, is 78 points, about 80 points. You say, Dan, what does that mean, the expected move? Just one standard deviation. There's a 68% probability from where we're at here around 56.70, we'll be down 80 and up 80. So if we go down 80, you're getting to around 5,600, a little under, right? So it's still technically, right about here. That's down 70, are down. What did I say the expected move was? Down 78, 80 points, and that's the full expected move. On the upside, that would take us to around 57.40, 57.50, right around there. So here's my playing field. There's a 68% probability we'll be between our expected move. We have nice positive theta. We'll let this percolate like a good cup of Folgers coffee. But that's at least some, just give you an idea to run with a little bit, to practice paper trade this during, if you're not familiar with it, during the Fed situation. And you see, get used to it, that type of a trade. So that's trade number one, using a calendar around a Fed announcement. But again, remember, I'm trying to leave Dodge before the Fed announcement. I'm putting this on kind of like stealth under the radar, trying to grab my theta and run out the back door. All right, idea number two. VIX is currently 23. Historically, that's a high number, high volatility number. Right now, I don't think it is, right? I think VIX has been, just in the last 2 weeks, VIX has gone from 34 to 22. We're at the low end of the range. I'm going to do a little back up here. If you look at 2022, which was probably in the last decade, the only year where we did an extensive deep dive on the downside in the market. SPX was down probably 10 or 11 months of the year, but VIX was in a range of 19 to 31, basically. A normal typical year over the last 10 years where we've been up, the VIX might be in a 12 to 20 range. So now you look at VIX of 22 to 23 and we say, oh, VIX is historically high. Well, historically it is, but like 2022, and right now, I think the VIX range for the next month or two could be 17 on the low end, maybe 30 on the upside. With the tariffs and 3 months, we're going to pause it, blah, blah, blah. There's still a lot on the table. I don't think we're going back to 12 or 13 VIX any week soon. So I think we're in a higher VIX range. So I think VIX 23 level isn't bad for doing a calendar type trade, right? In a normally historically high volatility environment. So here's that one. So we went from a 2-day calendar around the Fed to here's a calendar, May 20th. This would be an 18-day calendar. This would be 2 weeks from this coming Friday for my shorts, and my longs are 4 days past it. So I'm buying May 27, selling May 30, but I want to give you another twist. Number one, I'm talking about a little bit higher volatility for calendar 23 volatility. I'm entertaining putting a calendar on. I explained that. Number two, here's another twist. We're at 56.70. I'm going to place the calendar maybe at 56.40, 30 points under where we're trading at. Dan, are you crazy? What are you leaning? We've been going up. Why are you leaning short? I'm not. As they say, look at the Greeks, my friend, right? Here's the strike I'm choosing, 56.40. Here's where we're currently at, 56.70. Dan, why are you putting a calendar 30 points under? Check the Greeks. I'm as neutral as they come. Why are you doing it? By placing a calendar about 30 points under the market, it extends, gives me more room on the downside, which normally moves faster. And I'm fine on the upside, right? Unless volatility got crushed, which I don't think we're going to. But one of the other interesting things, folks, about doing calendars in a high vol environment, your break evens are like from here to Indonesia. It's a little bit of an exaggeration, but normally in a 12 to 15, 16 volatility environment, which I like calendars, your break even points might be 50, 60 points away. But if you look here, these vertical lines are my expiration break even points. And if you look at where we're currently at, and obviously we did this a little skewed where we started it, 56.70 is where we're at. And you look at the break even on the downside, 5,500, that's incredible. Why are we getting so much room? Because the volatilities are higher. So these were a couple ideas I wanted to share with you today to think about, dwell on it, consider, and paper trade these through the event, just get used to it. So we talked about number one, a calendar around a Fed announcement. Do those happen much, Dan? Every month. And how we might look at that. How's a way to look at it? Number two, looked at a calendar, about an 18-day calendar on a Monday. So 2 weeks from this Friday, my short, 4 wide, underneath the market. Why did we do that? And that hopefully helps you learn, hey, he can get more room to the downside, but he's still neutral deltas. I like that, right? So a couple things, hope you liked it. Folks, if you like this type of teaching, tomorrow we launch the May 10% class, a plan. We're basically work on trades together. We're trying to hit 4 to 10% a month on it, but it's not an alert service. It's a teaching you the craft service. We go over everything, but we put on live trades and we'll see what we get, right? I think it'd be a great opportunity to learn the craft, and we're explaining everything. So that's the neat thing about it. So check out our website, SheridanRiskManagement.com. Class starts tomorrow. And folks, have a good day. We'll see you later. Thanks so much.